John Taylor, good morning. Welcome back to EBnet Stream and to this fourth episode of Living Markets with Liberty. How are you doing, John?
Hey, I'm very good in yourself, Leon.
Very well, thank you. Another month of up. Well, it's been a bit volatile, I think. It's been
It
up and
has
down,
been.
up and down, but we've finished. We've got 1 day left of the month and we're 2% up again.
Yep,
So
absolutely.
I'm starting to see some people say this is getting too much. How are you viewing it at the moment?
I think I said about 2 months ago that it had run really, really hard. I was wrong. I was a bit early. This month, as much as it is a little bit up as we stand here today, we have seen markets move 2, 3, 4% in a day, easily both ways through the month, as you said, very choppy. So for me, it is taking a bit of a breather in terms of kind of holding steady, if not quite volatile in it. But yeah, I do worry that we run really hard this year when you look at the year-to-date numbers in the 20s and 30s, depending what index you look at.
Yeah, so I think it's 35 or 36% with this year-to-date or 12 months. I mean, that's incredible, that level.
Yeah.
Do you think there's pockets of value within the market? Has it been largely the gold shares that are running and driving the market up, or has it been more broad-based?
It's been a bit more broad-based than just gold miners, but there are still pockets that I think are potentially undervalued. So I certainly wouldn't say everything's overcooked, Leon.
Well, I'm wearing my green shirt today because I'm worried about the market, so I'm trying to cheer on both the box and the JSE. Long may the bull market continue. John, I started working now 30 years ago, so you don't have probably the benefit of the first few years that I got to experience. But when I started working, the asset management industry at the time was dominated by the insurance companies. Liberty being one of them. Libam was one of the bigger asset management companies in South Africa. There was another one called UAL at the time. There was obviously Sanlam and Old Mutual. I'm trying to think of who else I might be missing in that.
Southern Life, there were a couple.
Southern Life, spot on, 100%. These guys manage the majority of the wealth in South Africa. Now, at that time, and what's interesting is that it's a line sort of with now, but different, is that small caps had run up significantly. It had become the latest fad. There was a bubble that had been created. And a lot of those life companies, because of the sizes of their books, didn't follow that small cap boom. And they started seeing the markets as overvalued. So they brought back their asset allocation on what was balanced funds, the entire market at the time. And they were all underweight equity, quite significantly so, underweight equity. And their performance severely suffered at the time. But one non-life company that some people might know, Leon Greyling, was at the forefront of that. They were severely underweight equities and no small cap exposure because of their valuation type thesis. And they ended up losing significant assets almost to the point that business didn't continue and wouldn't be around today. What did end up happening was a lot of new guys coming to the market, a lot of new asset managers, all small guys coming in, building a quick track record off the back of exposure to the small caps. Names like BOE, Board of Executives. There was Cyfritz. Out of Cyfritz was born Coronation, one of the today's stalwarts. There was Prodigy. There was Fleming Martin Asset Management. There was Capital Alliance Asset Management. I can keep going with a list of names that just don't exist today, because what happened was the bubble burst, everything corrected, and those guys just couldn't sustain a business through that cycle. Interestingly enough, those same life companies struggled through that. Yes. Because they took not an extreme view, but a highly conservative view, and the market didn't have tolerance for the underperformance that's lasted through that, despite the fact that their reasoning was very good, and the life companies ended up having to rejig things a lot to get to where we are today. So now today, we sit in a situation where what were boutique asset managers then, Investec, Coronation, and so on, who had sort of broken in and were getting going, have done exceptionally well and are now fairly dominant. and the life companies have had to fit in a
Yeah.
bit in that regard. Today, 67 or 70% of our market is managed by the 10 largest asset managers, right? Including the Coronations, now 91, and the bigger life companies. Do you think it's similar today to then, where everyone's riding the market and that there could be a reversal, a lot of new names sitting in the top 10 in future? Because what I am seeing is new boutiques coming through. 361, All Weather, Marzi, and again, I can keep going with these names, and I'm seeing a bit of a similarity, but again, it's different because it's not like there's a small cap boom, so to speak. It's not like the guys in the top 10 are underweighting equity. So maybe a long introduction to the conversation, but I'm interested in hearing your view on how are managers positioning themselves in this market at the moment. Who are the up and coming guys that are being seen as sexy, but that you also think will survive? That they've gone through the sort of uncertain stages of their business. And how do you see this market looking? The same in 10 years, 15 years, or do you see a bit of a different lineup appearing?
Leon, yeah, Tish, a couple of thoughts on what you just shared. I think it's dangerous to say this time is different because there are certain similarities that ring true. I think there is a proliferation of managers that have come through. So the easy answer to your question, does the top 10 manager list in 10 years' time look the same as today? Absolutely not. I think that there is going to be consolidation. Some of the guys are going to fall off. Other guys are going to rise up very quickly. I guess the challenge is to identify who those are. If you think also what makes this time quite different to, I think, what we saw in the late 90s and early 2000s is the strong focus on transformation, on, identifying managers and transforming the sector, and not just from a lip service kind of point of view of, getting triple BE ratings right, but proper wholesale development of, born and bred black asset managers. And there you're seeing some interesting stuff. You've seen guys, splitting apart. You've seen guys coming together. You've seen names that were quite boutique 10 years ago, a Marzi and a Visio, becoming quite a lot more mainstream, and a lot of other guys coming out of the woodworks and setting up businesses. My main hope is that these guys, or at least a significant core of them, can reach scale, can move out of just pure vanilla equity management, and build up comprehensive multi-asset capability and into private markets, building out a really strong capability there.
Why is that your wish?
It's an imperative for the industry. Firstly, I don't think the industry is sustainable if we don't build up a strong core of genuinely black asset managers, number one. And secondly, I think it also talks to the fundamental shift in what the asset class landscape, particularly for retirement funds, but in general, is going to look like going forward.
But the struggle that I'm having with this debate, and I've been having it quite a bit lately, is so first of all, I do agree that the industry has to transform. I mean, that's given, but has it not already? So yes, transformation doesn't only need to be organically grown entrepreneurial black-owned businesses. The bigger guys transform in their own right, and you can start debating whether it's one person that's being ultimately benefiting from it, or whether it is broader based like Coronation did with their staff and taking a shareholding. But a lot of those big 10 are now black owned.
Correct.
It's beyond just the scorecard. They've had to go beyond that because people see through the scorecards at the end of the day. So from that perspective, I feel the industry's transformed, and I'm more concerned. Well, there's two things. So first of all, the smaller entrepreneurial guys are always going to struggle a bit in the context of Reg 28 because we can invest so much offshore now. So for them to be able to scour the world, even with AI, it's difficult. And to find an offshore partner that's going to happily partner with them, a small business in little South Africa, is difficult. So can they really compete in that regard? And then at the same time, on the other side of the coin, we need competition. That's why I believe that the need to diversify the industry, because the concentration is not healthy. It's not healthy for competition. It's not healthy for capital flows. It's not healthy for even the knock-on industries like the stockbrokers and so on. So what's your views on all of that?
Absolutely. The point around, scale and the difficulty for some of these guys to achieve scale has been severely impacted. And as you say, things like forex controls being relaxed so that more money can go offshore. Even just AI itself is both a blessing and a curse for some of these smaller guys. The other thing that I think we mustn't shy away from is, just how cheap and readily available and ubiquitous exchange traded funds and more broadly passive investments have become, which is a global kind of force that has introduced a new element of competition for cash flows in the South African market and globally. That being said, one can argue that it is exactly that kind of small, passionate manager that's not frightened of tracking error, who benefits and can play it out, whereas your big juggernauts that by necessity can't move too far away from the index are the ones that should be most scared of that.
EBnet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channel by clicking the subscribe button below, share this video with others you think will benefit from it, and give us a thumbs up if you are enjoying the content. That way you help us help you. Thank you from the team at EBnet. For more great content, please visit www.ebnet.co.za.
You just mentioned tracking error, and that's, I find, is an interesting discussion in the context. If you're consulting or advising a pension fund or even an individual, we would go through the process of assessing an asset manager, and we would assess them in terms of capability, the ability to return or produce returns, and the amount of risk that they take on. Surely we should be looking for guys that do bring risk, because risk results in return ultimately if done well. And our job as advisors should be to diversify out that risk, okay, theoretically in that regard. But what I find too much is we tend to look at the risk at the individual manager level too much. So, oh no, they tend to be too risky. But that to me is almost counterintuitive.
Yeah, agreed. I've been grappling with this question quite a bit lately, where I've been almost coming full circle back to that phrase that seemed to fall out of fashion, but I'm still wanting to think a bit like this, is around this kind of core satellite thought, to say that if you build a core with little to no tracking error, and you then can plug on genuine alpha generators around that, which will win some years and will lose some years, but your satellite kind of bets on the fringes, that's for me going to add more value than building a kind of core of low tracking error kind of in the middle, and paying potentially for very low alpha but active kind of pricing. That's one thing I'm thinking about. And the other bit that I'm thinking about is the extent to which AI is going to help us, keep a real handle on how that's all performing, and to help us to structure that better going forward than kind of just a fairly artificial kind of, say, 60-70 in something quite low heartbeat, and then you go and take some active bets with your balance, your 30 or 40.
If you think about it, a lot of it, because we spoke about the smaller, forget about whether it's black owned or not, but call it the boutique managers that are coming through.
Yeah.
And taking on exposure to some of them, they tend to get relegated into, people will call it incubation portfolios, or whatever the titles are that guys use. Once you're in an incubation portfolio, how do you become unincubated? At what point in time do you grow up, and are you let out of that portfolio? And people tend to get trapped there the whole time.
Yes.
They get traps thrown to them and never taken properly seriously. I'm going to challenge the asset consulting world to say, you know what, start thinking a bit differently, because surely if you do apply yourself and say, let's take on a bit more risk. So risk comes in different shapes and sizes. I mean, the one would obviously be investment risk of the portfolio. The other one's the business risk of survival. All right. So yes, there is a risk on the one, and it's difficult to control other than to assess and to try to make sure it's responsibly managed. But from an investment risk perspective, I think these guys can be given higher weightings and the overall risk managed better for the client, provided the consultant is competent enough to manage the client's psychology through those ups and downs that you spoke about, so that they don't knee jerk, oh, bad 3 years, they must be gone, kind of thing. So that's how do you, in that circumstance, manage a customer, but also how do you assess the business risk of one of these boutique type managers to try to assess whether they indeed have a business model that can survive?
Let me tackle the first question first, because for me, I think it's a bit easier. With the kind of incentives between the client and the asset consultant, the advisor, the key thing there, I think, is, it's a hard piece of work, but you do need to ensure that your incentives are aligned in terms of REM, and that you are quite clear with your client as to what good looks like, and what, conversely, what bad looks like. So to say, are we simply going to look at it on a pure risk return or even just a return metric? Then you're not going to be able to grow a lot of these managers, and you're going to miss out on good opportunities. It's that whole chasing last year's winner kind of problem. If you can get to a point to that with your client, where you can have genuine kind of the 4Ps, people, philosophy, process, performance kind of discussions, I think it can become a much deeper conversation that allows you to hang on to managers that you would have expected to underperform in that market, but that's why you're holding them, and you're not going to boot them to the curb for it, because it's part of the broader strategy. I guess your second part of your question, which is how do you assess that and how do you make sure that it is actually following the people, the process, the philosophy? I mean, that's our bread and butter as asset consultants. We should be taking a deep view of the market. I think AI is rapidly improving the way in which we can do that. When I look at the tools that are being built within our own setup, and I have no doubt with other guys, to keep a handle on that and just track those, those style skylines and the like, to make sure that the manager's doing A, what they say they're going to do, and B, what you've expected from them anyway, good and bad. I think that goes a long way. So it's about understanding your manager, knowing no one's going to be great in every situation, but when they perform differently to what you'd expect, that's when you're going to raise a flag.
I started off the discussion talking about history, and I think there's a lot that can be learned from history, not in the sense that history repeats itself, but rather what happened and what was the consequences, good and bad. Yeah. And that tends to remain when things go astray. But do you think, my experience of asset consultants, right, has been one of, we will go into the customer and we will focus on the past quarter.
Yep.
To update them, so to speak, on what is happening. Why do we spend so much time on the short-term type aspects when we preach? Okay, you shouldn't focus on the short term, and you shouldn't be led by the psychology of what happens in the short term. And why aren't we rather spending time not so much educating the customer, but helping them get a feel for that past, what happened when things came down, this was the consequence. So if you take a look at that history that we spoke about, had Alan Gray closed doors at the time because clients were just pulling money, right, we would have lost out on incredible performance from one of the leading fund managers in the world, right? Yep. Had we not supported some of the boutique guys like we have today, the Coronations and the Investex at the time, again, we would have lost out on an awfully good opportunity in that respect. But at the same time, simply willy-nilly throwing your money at performance because guys are exposed to small caps and looking great can cost you a whole lot of money. Absolutely. So as an asset consultant, sharing that and talking about those scenarios, surely that's more value for a retirement fund or even an individual to understand that world. And I'm saying I don't think asset consultants do enough of that. They're too
Yep.
stuck in the here and now type picture.
I agree, Leon. I think there's definitely a space to kind of have those discussions, as I said, around what should you expect from managers now, and actually highlight to your client and say, yeah, manager A has performed quite well in the last quarter, but that actually worries us because that's not in line with what we'd expect their style to do, and that's something that takes a lot of clients aback and say, why are you complaining about something good, but in the same way, you kind of, if you go to a doctor and the doctor says, you should be feeling that pain in your foot, and you say, I'm not, well, that's a problem, clearly. So I do agree with you. I think we need to move, and actually practice what we preach in some cases, where we say, yeah, last quarter, this is kind of how things rolled forward, but not focus overly on it. That's part of our early warning detection, but it's not the be all and end all. And I think it points a little bit to the fact that, like, when markets are running as hard as they have for the last 3 quarters, it's easy to arrive at a client and say, your portfolio is up 15, 20, 30%, depending when you look at it. It's easy discussion. You can close it out quickly. But have we actually stopped and said to our client, has the manager delivered relative to everybody else, relative to the market, in line with their philosophy?
But that's exactly the point. You and I have been having, I'm going to use the term, a fruitless discussion for 3 episodes. Okay, because we've been talking about the markets and then going, oh, do you think it's toppish, or don't you think it's toppish, or what do you think is going to happen? We don't know. That's the reality. Okay?
Correct.
We don't know, and there's no one that really knows. We only have opinions in that regard. And as a long-term advisor, we would be stupid to try to advise the client in that respect. So in that situation where things are looking so good, rather than focusing on the good and high-fiving each other through trustee meetings and reviews and stuff like that, we should be taking this time to say, right, let's take a breath. Okay, what is potentially to come? And that, to me, is invaluable advice from an asset consultant, is preparing your customer for the eventualities, so that when it does happen, it's not foolproof, but when it does happen, hopefully they can take a breath and say, you know what, this is not a total surprise. Right? We expected A, B, and C, so right, let's try to now see the wood from the trees here in terms of what actions we need to take. But I don't see that. It's like this hasn't thought about, gee, what an opportunity to consult, essentially.
Yeah, 100%. And again, it comes back to, I think, when the good times are around, it's easy to hit the client quickly, deliver good news, and everyone's happy. As you say, we high-five each other and we quickly move on. And then the contrast will be when markets turn, we're going to say, why did the manager underperform, and, go to that. But we haven't necessarily sat down and said, is this in line with what we'd expect? Does it still hit those kind of liability-driven objectives, those CPI plus targets, however you want to do that? And does it fundamentally change what we're doing? So I'm very careful at the moment when I go talk investments to my clients to point their eyes to the long-term side of the return graph and say, yes, absolutely, 1 year, 3 year, the numbers are amazing, 5 years even, but what that's done is it has improved our 10-year numbers back to a number that's respectable. And that's where I try to concentrate that kind of discussion at a start. And then when you want to deconstruct and unpack what's driven that, and managers and portfolios and asset classes, that then becomes a meaningful discussion to say equities are not going to run up at 20% a year for 3 years often. This is an abnormal situation we've had, and we need to ready our clients for that, number one. But as I said, unpack them into what can we do about it today to understand the future. As you say, we don't know what's going to happen in the coming 3 months. We really don't. But we can ready ourselves for those various scenarios so that depending on the client's needs and the liability profile, you can deliver in line with the requirement.
Is it also fair to say, from a client's perspective, they need to appreciate that when the markets have run up, even if the fundamentals have supported it, what it means is that the trigger required in order to force a correction becomes almost more tenuous, essentially. So it doesn't have to be some major economic event that creates it. It can be an earthquake somewhere can suddenly cause correction, and significantly so off the base that we're sitting at. And as we get higher and higher, well, any little thing can start impacting a speech given by Trump. Someone can end up impacting the markets.
I mean, you think about it, Leon. You were talking about in the late 90s when, a manager like Alan Gray suffered for a year and came close to closing down, or longer than a year, but certainly by the end of 98, it was looking bleak. And then 1999, 2000 were incredible years for Alan Gray. If you think back, there were a lot of underlying kind of bits of tinder around waiting to get lit, but it was one, devaluation in the Russian ruble that sent the entire global market into a tailspin for a year or two there. And I think we need to be careful of those exact same kind of things where there's all this tinder lying around in terms of trade wars and geopolitical uncertainty and markets that have run up incredibly and inflation that's still there and thereabouts and all of these kinds of things. And it takes, as you say, one speech, one market event that might be as obscure as a devaluation in one currency that can set off a lot of pain for a couple of years. But we also need to be in the context to say something like the emerging market currency crisis in the late 90s was replaced by one of the most incredible commodities runs we've ever seen in the early 2000s. And again, we've seen commodities run really hard in the last 2-3 years. Everyone, I guess, wants to know where to from here on that. The point is we don't know, but we need to be aware of how history has played out in that space before.
So what I want to encourage any trustee or individual that watches today's episode is the question that they should ask of their consultant or advisor over the next month is show me when this has happened before and show me what happened when it corrected and explain to me how that all happened just so I can have a perspective in that regard. And I think that's invaluable for any of them. And what I'd like to say to the asset consultants out there is, come on, lift your game.
100%.
Easy right now, but lift your game. This is when you earn your keep. And funds should start holding their asset consultants to account because this is exactly what they need to ultimately be doing. So anyway, we're getting to the end of our time. With your permission, I'm going to put you on the spot next time. All right?
Yeah.
Because there is a perception, and it's been around for many, many years, that life companies and banks cannot produce good asset management companies. Right? That perception's always been around. I think it started to, dwindle a little bit over time. So I'm bringing the sexiness back. I want to have that debate about why perhaps that was the case, because I actually think there's a fundamental reason for it, which has been solved. But I'd like to talk a little bit ultimately about that. But before we go there, right, we have to give our audience some excitement to take home with them. So we spoke about boutique managers, all right, the ones that are up and coming, the potential coronations, 91s, always worry that I leave someone out, prescience and so on of tomorrow, MP and so on. Throw me a couple of names, just 2 or 3 names of who you feel has the potential to ultimately get to that level that perhaps our audience has not really heard much about.
Yeah. One that maybe isn't as small as you were hoping for me to kind of lift out would be like a Truffle. I think Truffle has really proven that they can be a big player and they really are starting to earn their credentials quite well. That would be one. And then I would like to also point out, we mentioned both of their names earlier, like Amazi and Avizio. They're starting to also hit their stride. They're no longer small players, and I really think that there's some space for one or both of them to really stand out in the market. So they would be big ones. And then the other one that's been around a long time under different guises that I think also has got some space to grow is like a Camissa, the old Kagiso. I think that's also a business that's worth looking into for any asset consultant.
Okay, well, good. So it's also interesting you mentioned Truffle and the discussion that I said I want to have last time. A lot of those people came out of a life or bank-driven asset management company that struggled a lot within that environment. So I think that should be quite an interesting conversation. John,
Spot on.
thank you so much. Let's hope and pray for another 2% up. Or maybe not. Let's maybe hope and pray for just a bit of a flat, boring month so that things can settle and then go from there. All right, John, have a lovely weekend. Thanks so much for your time, and we will see you in episode 5.
Excellent. Thanks, Leon.
This is Leon Greyling for EBnet Stream and John Taylor from Liberty Corporate Benefits.
At Liberty Corporate Benefits, we believe that better benefits are better for business. That's why our holistic employee benefits give your employees financial security and lifestyle stability, freeing them up to be their best selves at work. With satisfied, engaged employees, productivity shoots up, workplace errors and loss decrease, absenteeism and presenteeism are reduced, and you attract and retain the best and brightest talent. After all, if you take care of your people, they'll take care of your business. Our brilliant basics are the non-negotiables that explain why more companies choose us than any other for employee benefits. Our employee benefits are easy and flexible, personal and relevant, and resource-backed, with investment solutions designed to help your employees retire comfortably. Comprehensive cover that protects your employees and their families. Financial literacy initiatives to help your employees make the most of their money. And a range of value-added services for holistic care and support. We make it easy to take care of your people and prove that employee benefits can also be employer benefits. Speak to us about getting the benefit advantage. Liberty Corporate Benefits.